Hello and welcome to our new investment strategy update. In July, we saw the first signs that price pressures in the US are slowing. But the Fed's fight against inflation is far from over. We're still a long way from its 2% target and the labor market remains very tight. This said, the Fed's path to restrictive territory may slow, starting in September, when we expect a 50 basis point rate increase. We see the Fed's policy rate peaking at 3.75 next year as higher borrowing costs trickle through the economy. A mild recession in 2023 remains our base scenario. Strong labor markets are a key variable for the monetary policy outlook, and we cannot rule out the risk of a more severe downturn in the US economy if the Fed needs to act more forcefully in the face of persistent inflation. In Europe, the question on everyone's mind is whether the continent can avoid a worsening energy crisis this winter. Gas flows through the Nord Stream 1 pipeline are uncertain, unreliable, and in any case, at much lower volumes. But the European economies are working to cut their gas consumption, fill inventories, and diversify their energy sources. Gas prices are and will stay high. That has a knock-on effect on inflation that will slow growth over the quarters ahead. And through this energy crisis, weak growth, and political instability, the European Central Bank has started a hiking cycle that we see peaking at 1.25 in early 2023. In China, weaker economic momentum has pushed the government to try to boost growth, and it is logical to expect more support in the run-up to the National People's Congress. The key risk to the Chinese economy remains its zero-COVID policy and the turbulent property sector. Overall, growth in the world's major economies is slowing as interest rates rise. So are we facing a hard or a soft economic landing? Well, the environment is complex, but the answer is largely in the outlook for inflation. Some improvements are likely later in the year as global supply chains normalize and as US demand cools. But commodity markets remain dependent on the war in Ukraine. All of this makes more macroeconomic volatility likely. Let's now find out from Stéphane what this means for our portfolio positioning.
Equity markets have rebounded after a difficult first half of the year, supported by solid earnings and better news on the US inflation front. Interest rates have fallen on expectation that a recession could force the Fed to slow or even reverse its rate hikes. So, have we seen the worst? Maybe not yet. Until inflation improves further and recession risks fall, more market weakness is possible. This is why our portfolio positioning is prudent. It makes sense to stay underweight in equities. We have strengthened our position in US quality stocks as they usually outperform in challenging markets. We actively manage our option strategies, which cover, for instance, 10% of equity position for a balanced portfolio. In fixed income, we are also underweight. We have reduced government bonds where falling yields makes valuation less attractive. We have also taken profit on Brazilian government debt as we anticipate more market volatility before October's elections. As Italy prepares for elections in September, we think portfolios should lower exposure to the country's sovereign debt. In commodities, we reduce our overweight. As risks shift from inflation to growth, commodities offer fewer diversification benefits. We see Brent crude trading around $100 by the year end, before dropping to about $90 mid-2023. Together, these changes have increased our cash holdings. We will use this tactically as opportunities arise. In currency markets, we think the US dollar and Swiss franc will continue to appreciate as global growth slows, while the euro and sterling face more weakness. Beyond the macro challenges that Samy described, market volatility also reflects the deep paradigm shift we are living through, including geopolitical tensions and the energy transition. The new realities will keep testing financial markets while creating new investment opportunities. Thank you very much for watching.